March 10, 2000. The NASDAQ hits 5,048 points. A sock puppet appears on a $2 million Super Bowl commercial. The company behind it, Pets.com, has never made a profit. Their business model? Sell heavy bags of dog food online and ship them for free. Lose money on every sale and make it up in volume. Investors don't care. This stock soars. Webvan promises to revolutionize grocery shopping. They raised $375 million, build a massive infrastructure, and burn through cash at breathtaking speed. Investors pour in more money. eToys is valued higher than Toys R Us, accompanied with actual stores, actual inventory, and actual profits. The old rules are dead, they said. Profitability doesn't matter. Eyeballs matter. Traffic matters. The internet changes everything. 268 days after that Super Bowl commercial, Pets.com was bankrupt. 2 years after the NASDAQ peaked, $5 trillion in wealth had vanished. The greatest speculative bubble since 1929 had burst, and millions of investors learned an expensive lesson about the difference between revolutionary technology and profitable investments. Now it's 2026. Artificial intelligence is revolutionizing everything. Companies with zero revenue carry billion-dollar valuations. Profitability doesn't matter, they say. This time is different. The technology is real. The euphoria is real. And so is the pattern. Act 1. The euphoria of 1999. Let's go back to 1999. The world was drunk on possibility. Amazon existed but was losing money. Google had just launched. Netflix mailed DVDs in red envelopes. But none of that mattered to Wall Street. What mattered was the story, the narrative, the vision of a future where everything happened online. Companies that added "com" to their name saw their stock prices double overnight. A study found that simply announcing a website could boost a company's market cap by 74% in 10 days. Think about that. No new revenue. No new products. Just a website. 74% increase. Initial public offerings became lottery tickets. Theglobe.com went public at $9 per share. By the end of the first day, it hit $97, a 1,000% gain. The company had revenues of $2.7 million and losses of $6 million. Didn't matter. It was the internet. The mania reached its peak with that Pets.com Super Bowl commercial. They spent $1.2 million on advertising in a single day, more than their entire quarterly revenue. The sock puppet became a cultural icon. But behind the mascot was a catastrophic business model. They were selling $30 bags of dog food for $20 and offering free shipping. The math was simple and devastating. Every sale lost money. More customers meant more losses. Growth meant faster death. But in 1999, nobody wanted to hear it. Alan Greenspan, chairman of the Federal Reserve, warned of irrational exuberance in December 1996. The market ignored him and continued climbing for 3 more years. By March 2000, the NASDAQ had more than tripled from his warning. Analysts created new metrics. Forget price to earnings, those were for old economy companies. Now it was about price to eyeballs and burn rate efficiency. Real metrics with made-up meaning. One analyst seriously suggested that Amazon should be valued based on customer lifetime value, a number they literally invented by assuming customers would keep buying forever. The bubble had its own language, its own logic, its own reality, and everyone who questioned it was dismissed as not understanding the new paradigm. Sound familiar? Act 2. The warning signs nobody heeded. The cracks started showing in early 2000, but a few people noticed. The Federal Reserve had been raising interest rates throughout 1999. Credit was getting more expensive. The free money that fueled speculation was drying up. But the party was too loud for anyone to hear the music stopping. In January 2000, just 2 months before the peak, a small company called Boo.com collapsed. They'd raised $135 million to sell fashion online. They spent it in 80 months, $7.5 million per month, burned through on a website that barely worked. That should have been the warning. It wasn't. The Super Bowl ads in January 2000 were peak absurdity. 17.com companies spent $2 million each for 30 seconds of airtime. Most of them would be gone within a year. Pets.com, Epidemic.com, Computer.com, Occident.com, MicroStrategy. Names you've never heard of because they no longer exist. The metrics kept getting stranger. Webvan CFO proudly announced they were only losing $130 per order, as if losing money more slowly was an achievement. They had a $400 million infrastructure to deliver groceries. Their revenue? $4 million per quarter. The math was screaming. The warning signs were everywhere. But euphoria is a powerful drug. In February 2000, magazine covers featured 20-something millionaires, the new masters of the universe. They were called kids who'd never run a profitable business, were managing billion-dollar market caps. Then came March 10, 2000. Hacked 3. The crash. The NASDAQ peaked at 5,048.62. On March 10, 2000, what triggered the collapse? A Japanese investment bank published a report warning that internet stocks were overvalued. That was it. Just a report. But when everyone's standing on the same side of the boat, it doesn't take much to tip it over. The NASDAQ fell 9% in 1 week. Then it kept falling. Pets.com, the poster child of internet euphoria, announced in November 2000 that it was shutting down. 9 months from Super Bowl commercial to bankruptcy. The sock puppet went from cultural icon to cautionary tale in less than a year. They weren't alone. Webvan collapsed in 2001, destroying $1.2 billion in investor capital. They'd built automated warehouses and a delivery fleet for a market that didn't exist yet. eToys, once valued at $8 billion, filed for bankruptcy in March 2001. Toys.com, the boring old company with actual stores, bought their name for $5.4 million. By October 2002, the NASDAQ had lost 78% of its value. $5 trillion in market capitalization vanished. The index wouldn't return to its March 2000 peak for 15 years, not until April 2015. The human cost was staggering. Retirement accounts destroyed. College funds evaporated. People who'd believed in the new paradigm lost everything. The technology was real. Amazon survived. Google thrived. eBay built an empire. The internet did change everything, just not on Wall Street's timeline and not at Wall Street's prices. The companies with real business models, real revenue, and real profits survived the crash and came back stronger. The ones built on hype and hope disappeared into bankruptcy. But here's the uncomfortable truth. Even the survivors took years to recover. Amazon stock peaked at $107 in 1999. By 2001, it was $6. It took until 2009, 10 years to get back to $107. Imagine holding Amazon stock for a decade and having zero gains. That was the dot-com reality. Act 4, 2026. Better returns now. Let's talk about 2026. Artificial intelligence is transforming industries. That part is real. Machine learning, natural language processing, computer vision and technology is revolutionary and will reshape how we work and live. But we've seen this movie before. Today's AI companies are trading at valuations that assume perfect execution, unlimited markets, and zero competition. OpenAI, while building impressive technology, has raised concerns about circular financing, investors essentially funding their own future revenue. Sound familiar? In 1999, it was the internet changes everything. In 2026, it's AI changes everything. Both statements are true. Both have been used to justify insane valuations. Memory chip manufacturer Kioxia surged 540% in a single year on AI hype. South Korea's Kospi jumped 76% thanks to a iLink chip. These are UNT startups. These are established companies, seeing their valuations explode because they reconnected to the AI narrative. The language is identical. This time is different. Old metrics don't apply. Revenue doesn't matter, it's about positioning. For the AI revolution, companies are spending $60 billion on single AI data centers with no guaranteed return. That's not investment, that's faith. Faith that AI applications will generate enough profit to justify the infrastructure spending. Maybe they will. Amazon's infrastructure spending in the 1990s looked insane too. But Amazon also had revenue growing every quarter. Many of today's AI companies have PowerPoint presentations and promises. The warning signs are here. Market concentration is extreme. A handful of AI stocks are driving the entire market. When a few companies account for most of the gains, that's not a healthy market. That's a precarious structure, waiting for a catalyst. Insider selling at AI companies is at historic levels. The smart money, the people who actually know what is happening inside these companies, is quietly backing away while retail investors keep pouring in. And perhaps most telling, not a single major analyst is predicting a decline. In a Bloomberg survey, 0 analysts forecasted that the S&P 500 would fall in 2026. 0, that's not healthy skepticism. That's universal optimism. And universal optimism is always a warning sign. The question isn't whether AI will change the world. It will. The question is whether investors paying today's prices will profit from tomorrow's revolution. The internet changed everything, but buying pets.com at $11 per share destroyed wealth. Buying Amazon at $107 in 1999 meant waiting a decade to break even. The technology can succeed while the investors fail. In 1999, the believers said, "You just don't understand the new economy." In 2008, they said housing prices never go down. In 2026, Tayyire Salinge is different. The words change. The pattern doesn't. History doesn't repeat, but it rhymes. The dot-com bubble gave us $5 trillion in lessons about the difference between revolutionary technology and sound investment. Will we learn from it? Or will we repeat it? The script is being read again. The actors are different. The technology is different. But the story, we've seen it before. And we know how it ends. Don't be the one holding the sock puppet when the music stops. If this opened your eyes to patterns you hadn't seen before, subscribe to Ahoba Finance Lumina Hayal. We don't predict the future. We recognize the patterns that repeat. Because in markets, what you don't see coming absolutely can hurt you. See you in the next one.